Hello guys, good evening. Yesterday we started talking about moving averages as the beginning of our indicator series, and today I'll be going deeper into it, and I'll be teaching you how to use it in your trades. Now, without further ado, I've already explained what moving averages are and how they are being formed, but today I'll be talking about how to add them. So to add it, you just come up here, you come up into this place, you come up to this place. Can you see? You just scroll in there, you scroll to the left and scroll and scroll, then you click on, you tap on indicators. Can you see? Then you search. We'll be using EMA, exponential moving average, or moving average exponential, depending on how you want to put it. Then I'll add it to my chart. Immediately I tap on that, it shows up on my chart. Can you see it? So that's the blue line here that you are seeing. This blue line you are seeing around the chart. I already explained yesterday that it takes the value of each candle close and divide it by the number of lengths you are using. So on your MT5 you'll be seeing it as period. So if you are using it, let's say we are using 55 period of 55 length, that means we'll be taking 55 candles into consideration to take this calculation. That is what it means, and you can use it majorly as support and resistance level. We have done two types of support and resistance in the past. We have done horizontal support and resistance. We have done trend line support and resistance. Now this is another form of support and resistance, and it's called it's called dynamic support and resistance. Dynamic support and resistance. DYNEMIC. Dynamic support and resistance. Now, as you can see clearly, when price hit it in this point, it bounced, serving as what? As a support. Then here, price hit it, went up, serving as what? As a support. Then here, price hit it and went down, serving as resistance. We have a lot of it happening. Let's go to another time frame. You see it's happening every time. Can you see price bouncing here, bouncing it? Can you see here bouncing? It broke it here, and it's normal. Every resistance or support has to be resistance and support are always broken at long run, so it's normal. Sorry, excuse me. So that is it. Sorry about that. I needed to attend to something. Okay. So now, apart from support and resistance, the next thing you can use, another thing you can use it for, is to define the trend. Now this is how you use it to define trend. When you see the candlesticks below the moving average, that means the moving average is telling you that the price is on a downtrend. When you see these candlesticks under the moving average, then what it's telling you that is that the price is trending down. Do you get it? Yes. And on the other hand, when you see the candlestick above it like this, when you see the candlestick above it like this one, like this, then you know that the trend is to the upside. Do you get it? That is it. Then another thing is that to trade this is very easy. You cannot just use moving average alone for your trading, but you can incorporate it to your trading strategy, such that if you want to enter a trade and you see the price like here, let's say you are planning to buy in this place, and you see price rejecting off this moving average, you have done your analysis, and every other thing fall in line, so you can easily know that there's high probability the price is going to bounce off that place. Do you get it? Another thing is that So you can combine 2 or 3 moving averages together to form another strategy called golden and dead cross. Golden, Golden, golden from the word gold, and dead cross from the word dead. How do you do this? You had 2 moving averages. Let's say you had 55, already added 55. Oh, let me just use 100 and 200 moving average. That's the most popular one. People use 100 moving average. Then you had another one, moving average exponential. You add it again. So that's it. That's the 2. Now this one should be 200. Let me make it a color quite different from the first one. Can you see it now? This is it. Now how to use this is very, very easy. Let's look for where cross happens. Now this is an example of it. Can you see the slower moving average, which is the 100? The slower moving average is the 100, is crossing the bigger one, which is the 200, is crossing it from above downward. When you see this kind of thing, we refer to it as a dead cross. We refer to it as what? A dead cross. When the smaller period moving average crosses the higher one from the top downward, they will call it dead cross, and it signifies a downtrend. When you see that, then it's telling you that the price is likely to begin to go down. As you can see, ever since then it has been going down and down and down and down up to now. It keeps going down. Here it keeps going down and down and down until now we are still there, still going down. Can you see it? So that is it. Then the other one that we have is what we call golden cross. Now golden cross happens here. Can you see it? Golden cross happens here when the smaller one, which is the 100 moving average, as you can see, if you tap on it, the 100 moving average is the one in blue. As you can see, is the one in blue, while the red is the one of 200 moving average. Now you see that the blue moving average is crossing the red to the top from below to the upside. Like as you can see, it's crossing it from below to the upside. When you have this kind of cross, we call it what? Golden cross. So when this kind of cross happens, it shows you that the price is now what? It's now bullish. Can you see it was actually going up before we have the cross again? Can you see when we have the cross again, then it begin to go down? So until we have that cross up again, we can still say we are in a downtrend. Let's look for a very long uptrend that we can cite as an example. Okay, I think it's long enough. Starting from here, can you see? Can you see from here? Then up, we keep going up. So that is another use of moving average. We use it in a dead and golden cross strategy. Now you can't use this strategy to trade on its own yet. It's just me teaching you how it was, the theory behind it. I will do a separate video on a strategy you can actually use this for. But for practice purpose, whenever you see this moving average cross each other, then you should buy. Then what? You should buy. Now look at what will happen here. If you are bought here, now at this point when this cross happen, can you see that the price above is at the top? Now if you had bought at that point, then the price will begin to come against you. If you don't have enough capital, it will pass you out before you now start going up. So one major way to avoid that is that once the cross happen, don't sell immediately. Don't buy immediately. After the cross has happened, don't buy immediately. Wait for price to come to any of the moving average. Then you buy in immediately. Price come back to it. For an example, after this cross, this cross that happened there, if you had bought directly at this point, price was here when this cross happened, then you'll be caught up by this downward and it can pass you out if you don't have big money. So what you are supposed to do is, once this cross happens, do not buy yet. Wait for price to get rejected. Wait for price to get rejected on any of the moving average. Then after this rejection that you are seeing there, then you can now buy somewhere at the top. You can now buy the breakup at the top here and ride the move somewhere here. Then you ride the move up, your stop loss below that low, then you keep moving it up like that. Then this would have been a very successful one. It really went up very well. Then immediately you see this cross back down, that's when you close your trades. This for swing purpose. If you are a swing trader, then you close your trade there. But if you are not, you would have taken your profit since. So you wait for another one. Okay, let's say you place this. Let's say you saw this dead cross here, then it came back here, it broke it out, there's no rejection, so you wouldn't even enter that day at that point because there was no rejection. It broke the moving average, and we say you should look for rejection, so you wouldn't enter that trade. Then we have another cross here. Look at another cross happened in this place shortly before it's now come and bounce at that moving average. So immediately this cross, let me zoom it. Immediately this cross happens, this cross here happens, you are not supposed to sell at that point, because at this point where this cross happens, price will be somewhere here. So if you sell, if you had sold there, then this pump up may have passed you out. Do you get it? So what you are supposed to do is to wait. You are supposed to wait for price. You wait for price to come back. You wait for price to come back and reject. Make sure you see a rejection. So for this one now, you are supposed to enter on seeing this huge rejection here. That's when you're supposed to enter. That's the rejection we are looking for. You can zoom down to lower time frame so that you can have a better entry. But even though if you had entered there, your stop loss will be very wide, but it never hits. Then it was kept going down and down and down and down and down. Then here it crossed up again. Now this place you might have issue because you will not enter early. You don't always win. You don't always enter yet, because here when the cross happened, it never came back to it. But that notwithstanding, we just wait for it to come. Then it finally came here. Do you see? So this will be your entry. This place, if you can have your first entry here. If you enter in that place and you have your stop loss below this place, you might get stopped out, but you have another bounce here, so you re-enter at this point again. Then you ride it to the top. You ride it up and up and up and up. Did you see it? So that is one way to use moving average. I hope you enjoyed this video. If you have a question, please drop it on the group chat which you belong to. Thank you for your time. Good day, good night.